I want to start with a number, not the oil price, not the inflation rate, a different number, 17%. That is the total return of the S&P 500 across the entire decade of the 1970s. 10 years, 17%. A single average year in a normal bull market produces that much. The reason the 1970s produced only 17% in a decade is that the world spent those 10 years inside a stagflationary trap. Oil shocks, a Fed caught between mandates, inflation that stayed elevated for years, and a market that went nowhere while the cost of living kept rising. Renaissance Macro Research published a note last week. I want to be precise about the language they used. They wrote that the parallels between 2026 and the stagflationary 1970s are, quote, the most compelling in 4 decades. Oil above $100, a Fed caught between mandates, sticky inflation, slowing growth, a weakening dollar, a narrow market driven by overvalued technology. I have spent 40 years studying cycles. When the pattern recognition signals fire this loudly, I pay attention. Today I want to show you the mechanism, not the headline. And I want to show you what the investors who survived the 1970s understood that most people around them did not. Here is what I am going to explain. First, why $200 oil is not a conspiracy theory, and why the more important question is not whether it happens, but what the chain reaction looks like at 110, 130, and beyond. Second, why the Federal Reserve is facing the most constrained position it has occupied since Paul Volcker in 1979, and what that means for every rate-sensitive asset in the world. Third, which sectors are structured to survive this environment, and which ones are mathematically trapped by it. I am not going to tell you to panic. Panic is the enemy of good analysis. But I am going to show you the arithmetic. And the arithmetic does not care about sentiment. Most people are asking the wrong question about oil right now. They are asking, will prices hit $200? That is the wrong question because it focuses on the end point rather than the chain reaction. And it is the chain reaction that will determine what happens to your portfolio, regardless of whether oil reaches $140, $150, or $200. Let me show you what the chain reaction actually looks like. Goldman Sachs, in their most recent research note, estimates that flows through the Strait of Hormuz have collapsed to 5% of normal levels. The net hit to global commercial oil stocks is 11.4 million barrels per day. That exceeds the assumption Goldman used in their entire annual forecast for 2026. Brent crude surged past $110 last week. WTI crossed $100 for the first time since June 2022. Now here is the number I want you to understand. For every $10 increase in the price of crude oil, headline inflation rises by approximately 0.7 percentage points. That is the historical estimate from S&P Global. Brent is currently at $110. Before the conflict began on February 28th, it was trading in the mid-70s. That is a $35 increase. Do the multiplication. 0.7 times 3.5 equals 2.45 additional percentage points of inflation from oil alone, above what already existed. Core PCE was already running at 3%, a full percentage point above the Fed's target. Add 2.5 percentage points. That is the arithmetic. Not an opinion, not a forecast, the arithmetic. The OECD has already revised its 2026 inflation forecast upward to 4.2%. Goldman raised its U.S. inflation forecast by 0.8 percentage points in a single note. At the more extreme end, polymarket bettors are placing a 35% probability on oil reaching $140 and a 13% probability on $200. Those are not fringe numbers. They are the collective judgment of people putting real money on outcomes. Oxford Economics has modeled $140 oil as a breaking point for the world economy, the threshold at which a global recession becomes, in their words, a base case rather than a tail risk. I am not telling you oil will hit $200. I am telling you that even the path to $130 has consequences that most investors have not priced into their portfolios. Here is what I have learned from watching these cycles for 40 years. The market does not wait for the outcome. It prices the sequence. And right now, the sequence is pricing in something that most retail investors have not yet fully understood. The Fed cannot save the market this time. That statement requires explanation. And the explanation is the most important thing I am going to say today. But first, if this kind of system-level analysis is useful to you, subscribe now. Subscribe now. Let me explain the Strait of Hormuz properly, because most of the coverage I have seen treats it as a geography problem rather than what it actually is. A systemic leverage point in the global economy. The strait is 21 miles wide at its narrowest point. 20 million barrels of oil pass through it every single day. That represents roughly 20% of global seaborne oil supply. Saudi Arabia, Iraq, and the UAE together exported 13.1 million barrels per day via that strait last year. Here is what makes it uniquely powerful as a leverage instrument. Iran does not need to win a war to disrupt the global economy. They need only make the strait sufficiently dangerous that commercial insurers withdraw coverage. That is already happening. Before the conflict began, war risk insurance premiums for a single transit were running at 0.125% of the ship's insured value. Within days of the strikes, those premiums increased to between 0.2 and 0.4% per transit. At some point, the economics stop working. Shipping companies simply do not send vessels into waters where coverage is unavailable or ruinous. As of this week, Goldman Sachs confirms that flows through the strait have collapsed to 5% of normal levels. Iran has made 21 confirmed attacks on merchant ships since the conflict began on February 28th. Saudi Arabia is attempting to reroute crude through the Yanbu pipeline to the Red Sea. The UAE is using its Fujairah terminal on the Gulf of Oman. Together, these alternatives redirect approximately 5.6 million barrels per day. That leaves 16 million barrels per day at risk from a full closure. Chevron CEO Mike Wirth said at S&P Global's CERAWeek last week, "There are very real physical manifestations of the closure of the Strait of Hormuz that are working their way around the world." He is right. LNG prices in Japan and South Korea are up 48%. Jet fuel costs are spiraling. South Korea has announced a 5-month restriction on naphtha exports. Several Asian nations, including China, are curbing their own exports to preserve supply. The Bloomberg reporting from last week carried a message that I found unusually direct for institutional sourcing. The world still hasn't grasped the severity of the situation. I believe that assessment is correct. Markets are pricing in optimistic scenarios that may not materialize. The window for those scenarios to materialize is closing. Goldman Sachs warns that if a naval coalition cannot secure safe passage within the next 14 days, Brent could test $150 per barrel. Oxford Economics modeled breaking point is $140, sustained for 2 months. I want to be clear. I am not predicting any specific price. I am describing a mechanism. The mechanism is real, it is documented, and the range of outcomes it can produce is wider than most investors are currently positioned for. Now I want to explain what I believe is the most consequential development in this crisis, and it is not the oil price itself. It is the position of the Federal Reserve. Before this conflict began, the market had priced in 2 interest rate cuts for 2026. Futures traders were pointing to June as the most likely timing for the first cut. That was the framework that supported equity valuations in January. As of yesterday, the CME FedWatch tool shows a 98% probability that the Fed holds rates steady at its upcoming April 28th meeting. Market expectations have shifted from 2 cuts to a serious discussion of 0 cuts for the year. More significantly, the Fed put, the implicit understanding that the central bank would step in to support the market with lower rates when conditions deteriorated, is currently suspended. I want to explain why that suspension matters at a structural level. When inflation is the primary threat, cutting rates is not an option the Fed can use to soften a market decline. Lower rates mean more money chasing goods that are already expensive. In an oil shock, that produces more inflation, not less growth. The Fed's own projections now show GDP averaging 0.9% in 2026, down sharply from earlier forecasts. At the same time, their inflation forecast is moving higher. Ed Yardeni has said he has raised his odds of 1970s-style stagflation to 35%. The reason I keep returning to the 1970s is not nostalgia. It is because that decade produced the only sustained period in modern history where both stocks and bonds declined simultaneously for years. And it happened precisely because a Fed caught between inflation and recession chose to prioritize neither decisively until Paul Volcker arrived in 1979 and administered what he himself called shock therapy. Here is the arithmetic of the current moment. The S&P 500's information technology sector represents 32% of the index. These are the highest multiple stocks in the market. When rates rise, or fail to fall as expected, the present value of future earnings falls. That is not an opinion. It is discounted cash flow mathematics. Microsoft dropped 23% in the first quarter of 2026. The SPY is down 7% year to date. The VIX sits above 30. The 10-year Treasury yield has climbed sharply. Consumer confidence is deep in pessimistic territory. A multiple compression environment combined with earnings pressure and weakening demand produces the conditions for a prolonged stagnation, not because of one shock, but because of the interaction between shocks. Let me now be specific about what the data shows regarding where money is moving and where it is not. Energy is the most direct beneficiary. Infrastructure companies in energy act like toll collectors and benefit from volume regardless of price. Defense is another beneficiary, particularly companies tied to replenishment of military systems. Airlines are structural losers due to fuel costs. High multiple technology is under pressure due to rates. Consumer discretionary is squeezed as savings decline and costs rise. The counterintuitive survivors are companies with pricing power. Healthcare, essential industrials, agriculture, and high dividend stocks with real income growth. Let me tell you what I actually believe. We are in a sequence, not an event. The oil disruption has already happened. Inflation is spreading. The Fed's response will determine whether this becomes a multi-year shift. The Fed put is suspended. When inflation is oil-driven, monetary policy cannot fix it quickly. The 1970s mechanism is active again. Investors who understand the mechanism position differently. Here are the current numbers. Oil is above $110. Equities are down. The Fed is holding. Stagflation probability is rising. Inflation forecasts are increasing. These are the coordinates of the environment. In the 1970s, the investors who succeeded adapted to the environment. The same applies now. The question is whether you are positioned for the current reality or the past one. Let me close with this. The Hormuz disruption has created an inflation mechanism the Fed cannot easily control. The result is a constrained market environment. This is not about predicting prices. It is about understanding the chain reaction. The sequence is in motion.